Shale as a Ponzi scheme. Last week we introduced Dan Dicker's latest book, Shale Boom, Shale Bust. But Dan, we're really generating some buzz now because that's a pretty bold statement to make.
It is. It's incendiary, and I sort of meant it that way in some ways to inspire some interest in the book, because Shale, what I mean by a Ponzi scheme is not it's a fraud. That's not what I mean. What I mean is that it requires, like a Ponzi scheme, endless increases in capital in order to keep the pilot going.
So is this different than regular oil production? Is it just specific to shale?
Exactly, and shale is very unique in that you get an enormous front-weighted amount of your production. Most of the production that you'll get inside of a year. 80% you'll get inside of a year, and 50% of that you get inside the first 3 months. So what you have is you have an enormous front-loaded nature of production. That means your profits are front-loaded too. So you stand there and you drill a well, and in fact you get a tremendous initial blast of cash flow. But in order to keep that cash flow going, because the wells just drop off so rapidly, is you have to continually drill more and more and keep those fresh production numbers coming in. And Wall Street, all they really want to see, if you're an oil company, is they want to see production numbers increase, and they want to see the profits increase. And the only way you do that is, in many ways, like a Ponzi scheme. You have to keep on rolling capital in, keep on drilling, the numbers keep on getting bigger.
Right, so there's obvious winners and losers here, and the losers, let's start with that. They're going to be the over-levered companies with horrible debt on the balance sheet.
And that's why, that's why I talked about shale as a Ponzi scheme, is because what happens is you have to throw constantly more capital at it, and you get certain companies that will leverage themselves deeply into it to continue to ramp up drilling. And then if you have, like we have now, a drop in oil prices, all of a sudden the economics don't work anymore,
right,
and you have some serious debt issues. So there are a lot of companies out there who are in the middle of what is going to be a very difficult time over the next 3 or 4
But there
years.
are some winners too that do have that decent balance sheet. A name like EOG, for example, which has seen a lot of bullish flow as of late.
Right, and that's really where I was going with the whole idea of a Ponzi scheme. It doesn't mean that I think that everywhere that investment in shale is bad. What in fact you want is you want those companies that are in a responsible way developing their acreage. They have prime acreage. There's a large portfolio of drill sites yet to be developed, and they're not over-leveraged, always trying to chase as frantically as they can the next dollar and the next well. And names like EOG are exactly the kind of names we want to be investing in for when this ends, this drop in oil prices ends, and it certainly must end. You'll want to be on the back of some of those names.
Okay, thanks very much, Dan.
Right.
For The Street in New York, I'm Jill Malandrino.